from Washington. We'll turn back now to Jackson Hole and what we just heard from the Fed chair, with major averages rallying higher this morning. Bianco Research President Jim Bianco joins us. I think of you as bond guy, Jim. So we did see bonds rally, treasuries rally on the back of this speech. The dollar also lost some of its gains and weakened pretty substantially. Were you surprised at all at what we heard and the market reaction?
No, I wasn't surprised because the speech was more of a confirmation of what the market had been expecting. And the rallies that we're seeing just undid yesterday. There was a fear in the markets, both in the bond and the stock market, that Powell might come out a little bit more hawkish than everybody thought, and he didn't. So we undid yesterday, and now we're going to try and parse through the speech. I think the big takeaway in the speech is, obviously they're going to cut rates in September. We know that. But we don't really know how far they're going to go after that. How much do they plan on going, hundreds of basis points or 3 or 4 rate cuts and be done with it? He did imply that the labor market is now going to take center stage. The payroll report is going to probably surpass the inflation report as being the most important statistic of the month.
So what is the bond rally telling you? The fact that they're increasing odds of a 50 basis point cut in September, the fact that there's still 100 basis point of cuts priced in by the end of the year, does that look right to you or a little much overdoing it?
Well, I'm in the no landing camp, and meaning that I don't think that the economy is having a soft landing. I think it's doing better than that. And I fear that all of these cuts that we've got priced into the market might be overdoing it and set the stage for sticky inflation throughout 2025. So I'm on the opposite side of Chairman Powell. I don't have confidence that we're on the way to 2%. Now, we've seen this before. We saw this in January, incidentally, coming off of another Powell speech where he kind of said we're on the way to 2%. And then inflation shot back up in January. And then that put on all the cuts for all year on hold until September. So I think that the economy is going to continue to stay stronger. Now, the bond market, it kind of reacts to what the Fed is doing and a little bit of hope in that they're going to get rate cuts because the market wants rate cuts and it wants to see that the rate cuts are going to go there.
What are you seeing in the inflation reads that the Fed is not seeing that keeps you worried about it?
It bottomed a year and a half ago at 3% on CPI, and it really hasn't made any progress. It's a 2.9 now. It's taken almost a year and a half to go down a tenth. The seasonality, or what we call the base effect,
has gone down to 2.5%. That's moved more. That's what they care about.
Right, but core inflation has gone down, but also the same thing with that, right? The Fed's target on core PCE is 2%. It's not 2.5, and and there's evidence that that might be bottoming it near these levels. I think we're at those cyclical lows in inflation. And again, because I think the economy is going to do well, one last thing is inflation is probably the hardest economic indicator to predict, but everybody on Wall Street thinks it's the easiest economic indicator to predict. And go back to transitory 3 years ago, and even Jay Powell got a nervous laugh in the crowd when he acknowledged that they got that completely wrong 3 years ago. It's a difficult thing to predict. They're basing everything on this idea that the labor market is weakening, but the data in the labor market is very mixed. Whether you're talking about the SOM rule or the recent revisions down, there's an argument to be made that we've had a big expansion in the population of the country via migration, and that has been bringing different demographics into the labor market, which makes looking at the unemployment rate going up not clean. And that's why Claudia Sahm herself has said that maybe her recession indicator is not going to be correct because of the increase of excess supply. I wish he would have addressed that. He seems to be taking the data at face value. If the unemployment rate goes up, we have to cut. Is it because we've got migration pushing up the unemployment rate? He isn't addressing it.
But I'm sure you agree, Jim, that the analogs of when you're off this much off of the cycle low in unemployment, it tends not to be good from there.
Yes, but those analogs are based on the idea that the population of the country is stable and predictable. We have had anywhere between 7 and 15 million people come into the country in the last 4 years. The population of the state of Arizona. Now, 7 or 15, depending on which metric you want to use. We don't know what that's really doing to the unemployment rate or to the labor market rate, because the revisions, there's been a lot of talk about that 818,000 lower revision. We all say that is an elimination of jobs. It might be a replacement of jobs between W-2 workers and under the table workers. So that job still exists. They still make money. They still spend. They still continue to push the economy higher. This is a dynamic about the labor market that needs to be fully understood, because we've never seen a population surge like we have in the last couple of years. And all the labor data is based on the idea that we have a stable population.
So you're not a buyer of the Goldman view that the 800 is more like a 300, that the revision was exaggerated in their words?
No, I'm a total buyer of that. I think it was exaggerated, and that it is closer to about 300 as opposed to 800 because of the potential of the immigration that we've seen in the country over the last couple of years.
Interesting.
Okay, Jim, we'll leave it there. Appreciate you joining us on Jackson Hole Day.
you.
Jim Bianco.
After this.